All right, good afternoon and welcome. This is our 12th edition of The Growth Factor. By terms of introductions, my name is Brian Robb, Managing Director here at Lasater Capital. And as always, I'm joined by our CEO, Ty Lasater. Ty, thank you for being with us today. We've had a busy week with headlines and a lot of news out in the marketplace and a lot of questions that we've received from investors related to some of the geopolitics and the flight to safety and the flight to safety actually going down. So there's a lot of headline news, a lot of clickbait that's out there recently. Some of the headlines that I actually looked at from today, warnings of $200 barrel of oil as the Strait of Hormuz is sealed. Oil surges, stocks plunge as fears of a prolonged war hits markets. I saw something, the Dow plunges 1,100 points earlier today as investors fret over war. A lot of concerns over crude futures surging as much as 13% to top 82 a barrel, with West Texas crude just below 71. We think it's really important to state markets are always going to be volatile. This is not the first time, and it's certainly not going to be the last time that we see volatility. It's certainly been exacerbated by some of the recent news of the past couple of days. Today, again, is March 3rd, 2026. We did see the S&P drop as much as 2.5% earlier today. Now it's come back somewhat, and we're closing just about to hit close of market in a couple of minutes here. It should end up closing down about 1%. So it's still down significantly, but saw a very steep spike from earlier today. What about price earnings? Price earnings for the S&P still sits around 30. The cyclically adjusted ratio is closer to 40, but keep in mind that really should be in normal times around 15 or 20, even a tad higher when you think about high growth technology stocks. And we have had some blips along the way like COVID, but it has essentially been 26 years since we've had a major market correction. So the big question again is generally what happens when there is global unrest and uncertainty. I think the first is just obviously overall fears of a broader market correction leading to a flight to safety. And typically we see three asset classes that are sought after. The first one is precious metals, gold specifically. The other is treasuries. And the third is real estate, although we've seen record high gold prices as well. So, Ty, let me turn it over to you for a minute and just get your perspective on what you've generally seen in periods of volatility and how real estate reacts to that.
Yeah, well, I think, we've been discussing for quite some time now that this economic environment and this looming, if you will, market correction mirrors very similarly to the 1999-2000 dot-com bust. Which that bubble happened, and then there very soon after 18 months or so, we went to war because of the World Trade Center conflict and everything that happened because of that. And so there's a lot of similarities here. Conflict brings, especially conflict in the Middle East, brings a number of concerns to the marketplace. This time we've got these AI stocks that have significantly been arbitrarily valued based on expectations, and those expectations of what they're going to bring to the marketplace have maybe dipped a little bit over the last few months, and we're starting to see somewhat of a correction there. And then you bring in this conflict, and it's going to exasperate that more so. And you step back and you've got to look at your portfolio. You've got to look at your finances. You've got to look at everything that's going on around you and say, where do opportunities lie? And if for somebody like myself, leading into this, I've been looking at a number of and acquiring a number of defense stocks for the last 6 months or so. About 12 months ago, my dad and I sat down. We had a long conversation about our portfolios, and started really looking at a number of defense stocks at that point. This is, if you're looking at those now, it's probably a little bit too late. But we've done very well on those, and we'll continue to do so. But we're also going to see a lot of these tech stocks start to revalue pretty quickly, and so you've got to say, okay, where does the opportunity lie? And we've seen infrastructure being moved from the colder markets where typically it's more efficient to get energy because you don't have to cool a large hot space with all the computers that are running. But they're looking at areas that have low infrastructure now and focusing more on the incentives that those markets and those communities will bring for building infrastructure in the area to run these tech companies. And so, we've got portfolios in a number of target cities that these tech companies have identified as where they're moving to build infrastructure. And it's taken a huge boost to our real estate portfolio there. And so, real estate becomes a great opportunity, as it always has during times of conflict. You can go back to World War I, World War II, leading up to those conflicts. Banks were struggling to make loans. The cost of a mortgage was unaffordable. And that's when banks came out with a new product, a 30-year mortgage. There's a good likelihood that banks are going to use this conflict now to justify the 50-year mortgage, and we're going to see that sooner than later. And so you've got to get creative, and creativity does not lie in your traditional stocks, bonds, and mutual funds unless you're positioned in the right ones going into a time of conflict like this. But as you said, we're also going to see the impacts of inflation and what it does to gas prices. I was actually on TV and a radio interviews today and talking about, number one, what does this conflict do to China? We see China getting extremely frustrated and aggravated that we've entered into the conflict because ultimately what we've seen is Iran has cut China off from importing or exporting from Iran into China their oil already, and so that's got a huge impact on the Chinese market. And rest assured, Trump knew that going into this conflict, and he was hit with an adjustment to the tariffs that he had made, and was going to have to look at different ways to handle accomplishing his agenda, both in the Middle East and in Eastern Asia. And so now this conflict is one way to start squeezing China and get them to move in the direction that Trump ultimately wants them to do so. And so now is the time to be watching, as we've talked about, that market correction that's coming, and we're seeing it. Last week, I think we saw a 1% adjustment, and again, as you mentioned today, we're going to end at about 1%. And both those numbers are significant numbers at a roughly 50,000 Dow Jones, and so a large correction like that early on is the indicator of what's more to come. And so now is the time to start moving chips off the table and into some of those physical assets like you were talking about, real estate, gold, silver, and so on.
Yeah, I think to give some perspective about the oil, about a fifth of global oil is shipped through the Strait of Hormuz. It's a huge amount. It's a very critical artery for energy. But to your point, they've already been under sanctions on shipments to the U.S. But preventing that to China could actually have a big impact to some of the markets in Asia. I think closer to home, elevated equity valuations definitely leaves less margin for investor disappointment. You mentioned AI. That's especially true around all of the enthusiasm that we're seeing around AI, which clearly is beginning to moderate. It's been, as we've talked about in prior episodes, a big growth factor for the Magnificent Seven. The overall weightings as it relates to AI has been severely capitalized as it relates to AI stocks. But I would say overall, corporate earnings and margins are still strong. Obviously, we have yet to get to the quarterly earnings reports, but it does provide some cushion to the underlying markets. But I think it does reinforce that discipline over reaction is really critical in markets like these. And I was surprised when we talked to investors and you explain that if you have a 10% drop in your portfolio, it's going to take a lot more than a 10% gain to get back to even, right? It's going to take a 12 or 15% gain, and you can do the math depending on the amount of the drop. So it is also very interesting as it relates to inflation. And I'd like to get your take on this, Ty. When you do have a spike in energy prices, generally the Fed may opt to hold steady on rates or potentially even increase them. As we know, we're going to have a new complexion in the Fed board coming up in just a couple of months. June, I think, will be the first full meeting with the new chair and four new members. That could be tempered by a flight to, again, some safety and a flight to treasuries, which can have a deflationary effect on overall rates. So you kind of have those two canceling each other out. What do you feel like the future for the rate environment looks like, seeing there's so much pent up anticipation of hopefully lower rates at some point in the near future?
Yeah, well, I mean, I think we've been so focused on bringing rates down for so long. That's, first of all, still at the forefront of everyone's mind. And then, you bring in the impact of a conflict in the Middle East, and we know based on history that is going to impact gas prices for sure. We luckily have a really strong reserve, and we've got a president that is focused on drill baby drill right now, and so that's going to help alleviate a little bit of that pressure. But then furthermore, CPI doesn't take into effect both food products and gas, and so there's going to number one be a little bit of a delayed impact of the increased cost in gas impacting traditional consumer goods that are focused around for the CPI reports, and so that gives us a little bit of time in and of itself. So these next couple of meetings, they're not taking into effect rising gas prices, and consumer products have not seen the impact of those rising gas prices hit their products just yet. So I think it'll be a couple of months before we see that impact, which helps us, especially with the current Fed chair. And then, as we move into, if there is somewhat of a prolonged conflict in the Middle East, which with Trump's focus so far, we've had a fly in the night demolition of the rockets and the bombs that we suspected Iran being involved with a few months ago. We had another raid in the middle of the night to address a leader in South America that ultimately was captured and brought to American justice in the night in a very short order and swift order. I think with what we've seen of Trump, and knowing that Trump does not want to be involved in a prolonged conflict in the Middle East, we can expect very swift and aggressive approach early on to hopefully bring down the lasting impact. However, if there is prolonged impact in the Middle East from this conflict, housing is going to be a huge focal point. We still have strong unaffordability in the housing market, and so even if we do see inflation of some aspect that impacts the greater U.S. population, then I think Trump's focus is going to stay on bringing down the cost of housing, because if we can't address inflation in consumer products, we can't have both escalating inflation in consumer products and a lack of affordability in housing as well. We're going to have to address one of the two, and I think inflation is reasonable if it falls in the 3% range. And I know the current Fed chair is pushing, for the low twos. I just don't find that economically feasible at this point. And so the next best thing is to address housing. Housing is out of control, and the cost of housing. And so the fastest way to address that is bringing down interest rates. And so I think that will still be the main focus, at least for the foreseeable future through 2026.
Yeah, I think, just a 5 or 10%, even a 10% increase in oil prices really only impacts inflation about zero point 0.1 to 0.3%. And, seeing that we are still experiencing core inflation around 3%, that's still within the target range. I think the Fed will largely look through that unless there is some sort of prolonged conflict in the Middle East. But I think, in times like this, it's important to maintain a long-term focus. Markets have historically absorbed wars and geopolitical crises. Long-term outcomes, as we've seen, are really driven more by fundamentals than headlines. And it's easy, I think, to be influenced by some of the headlines out there. And we would always recommend avoid emotional investing. You want to plan for the long term and adjust your allocations now in a way that benefits you really for the long run. And that really also includes a tax advantage strategy. Some of the things we actually talked with a individual at a family office earlier today, and we've used this number on an earlier episode, but the 50-30-20 is the new 60-40. The 60-40 is kind of your traditional 60% equities, 40% fixed income or bonds. And moving forward, most planners are saying that should be 50 equities, 30% fixed income slash bonds, and 20% alternatives. That's the way most family offices, actually for ultra high net worth, it's more like 50% are invested in some sort of alternatives, with about half of that allocation into real estate. And the reason for that is when currency erodes, real assets like housing and real estate tend to absorb any excess money supply.
Correct, correct. I think we're seeing more and more of that, especially, as we begin to, or we see the wealth growth here in America, and really the upper class making a larger spread between the lower income, and we're seeing more and more younger millionaires, and a lot of that is brought on because of social media, and a lot of that money and a lot of that wealth that's created is moved into tangible assets like real estate, and so you start to see a shift in what that investment dynamic looks like. And the thing about real estate that I always talk about is really those four key factors that it has the potential to bring, in the form of equity. You're able to buy in equity when, whether you're partnering with an operator who has access to off-market deals like we do, you're purchasing equity or a discount on the front end, or in a rental portfolio, you typically do. You have a tenant that's paying down your leverage, building you equity over the long run. You've got appreciation. When you buy in the right market, obviously it boils down to location, but in the right market, you've got appreciation, you've got the opportunity for cash flow. In a strong market, you see strong cash flow. In a market like we've had over the last couple of years, with interest rates as high as they are, with inflation where it is, sometimes that cash flow will take a dip, but that cash flow is a huge benefit and a huge boost to your portfolio when you're able to draw off of the cash flow from real estate and not have to dip into or sell assets or sell equities in order to see that cash flow like you would in a traditional retirement account. And then the fourth thing is obviously the tax advantage that comes with real estate that you don't see across the board. And so when you're talking about extremely high net worth families, whether it's a family office or family like myself and my brother that have built our portfolio the way that we have, you need the tax advantages, first of all, to help alleviate the tax pressure across all of your investments and all of your forms of income. Two, the cash flow is fantastic because you then start generating that passive income. So, you're working for income and you've got income that's coming in, no matter what you do from a physical activities perspective or a working perspective, just based on the investments that you hold. And then you've still got the growth. Typically with your traditional equities, you may have growth, but you've got to dip into that growth to generate the cash flow that you need to live off of once you get into retirement. And so that's why you see the extremely wealthy families not build a portfolio that is a majority or significantly all of in equities, with the remainder in fixed income. As we all know, most of the fixed income opportunities come with absolutely zero growth. And depending on what they are, you may be actually buying or using into your principal on the fixed income approaches, and so you're then having to look at an equation of, am I going to outlive my retirement? Versus if your investments are generating cash flow, no matter what, you're not dipping into the overall equity. So, I think that's where the opportunity lies.
Absolutely. Well, let's talk about some of the key takeaways that I think would be important for our listeners. I really see two avenues to take. One is continue to sit by the TV and kind of worry about things and wonder what's going to happen and bury your head in the sand and hope for the best. As we like to say, hope is not a strategy. That's certainly one option. Option two is actually talk to a professional and understand how this can actually impact you and what your overall allocations do look like and possibly should look like. So, some of the key takeaways, I think it's important for people to understand real estate not only endures inflation, it can outperform inflation, especially during periods of rising prices. And over time, the fundamental demand has really I'll say, driven consistent price growth. So those are two really important points to think about. The third, I would say, because we do talk to a lot of investors that have invested in precious metals and may actually be looking to move more into precious metals during these periods of instability. Gold can be a hedge. Gold is not a hedge when it's trading at record highs. This is kind of financial planning 101. You don't want to buy high and then wait for it to go down. You want to buy something when it's at a reasonable valuation. Real estate is providing some great valuations today. So not only is it a great hedge, but it's also a great opportunity to experience forced appreciation in a lot of the properties that we're considering. Gold also doesn't provide cash flow or tax advantages. And the other key takeaway I think it's important for everyone to know is rental demand often remains consistent or it even rises as potential buyers shift to renting during these types of market downturns, and that really supports income producing properties. So, market instability really can create a lot of opportunities to purchase discounted properties. You combine that with the last several years of interest rates, and again, it's really this kind of perfect storm of generating very attractive deals in the market. Ty, would you have any other advice or final kind of points?
Yeah, I think you bring in a good point there with the time to buy, and because of the conflict that we've started to see, we've seen gold already take a jump up, but real estate is like a massive ship. It's a little bit slower to turn, and we're setting on the back end now of one of the greatest opportunities of our lifetime to start acquiring and building wealth in real estate. It's a greater opportunity than the 07-08 subprime crisis because what we're seeing right now is operators, not homeowners, not individual homeowners, owner occupants who were maybe put into a mortgage that they probably shouldn't have qualified for, that they couldn't afford. All of a sudden, the subprime crisis starts to burst and they're without a home and they see foreclosures. We're not seeing that this time around. What we're seeing is operators that don't have access to equity and to additional capital getting put in distressed situations because of the cost of their debt and debt coming due, and they're not able to have the resources to restructure the debt, refinance the debt, or restructure the capital stack. And so we're looking at a small window of opportunity that is presenting one of the greatest buying opportunities, and it's going to be very short-lived because operators like ourselves is swooping in and taking advantage of those opportunities. And so this is the time to really move and take advantage of this window of opportunity, and to the tune of, we've had some of our early funds. We had a really early fund that we expected it a 17% IRR. and we ended up hitting 21% on exit. We had another fund that we were expecting to be a 3 to 5 year fund. We exited in 2 years and hit 14% annualized rate of return on that fund in 26 months. Unheard of. And that was coming out of the subprime crisis. That was also coming out of COVID. And we're at an even better opportunity. I'm seeing better opportunities now than what I saw then. And I'm looking at deals right now. And in fact, we've adjusted our current fund for opportunities for investors who are looking to get into real estate, maybe for the first time, or to double down and really start reallocating assets into real estate. We're creating an opportunity right now in our current fund because of what we're looking at right now in the marketplace, where we are offering to investors 14% before we make a dollar. And that is unheard of, but it's because of some of these opportunities that we're seeing right now, and it's going to be for a very, very short window. So this is the time to get in and get involved. Absolutely, to get in at one of the best times that we've seen of our lifetime to really take advantage of buying at a discount. Getting an opportunity where you're buying equity on day one on the front end, so that not only do you have the discount and equity working for you, you have greater ability for appreciation for that asset to take off as the markets start to correct. And we're looking at, with doing less leverage and a lot lower leverage, we've had a lot of interest already in this fund, and enough so that we're looking at using much less leverage than what we otherwise would. And with that, it creates greater cash flow for all of us investors that are involved in the fund. And so it's really hitting all four of those aspects all at one time in this unique opportunity.
No, that's great, Ty. And I would encourage anyone who has an interest in hearing a little bit more about that to visit our website. Again, that's lasatercapital.com. You can click on the contact us section, and we would be happy to set up some time to talk to you about your specific situation and how some of the strategies that Ty just mentioned can benefit you specifically. Um, Again, just to wrap things up, my name is Brian Robb, Managing Director here at Lasater Capital. I'm joined by Ty Lasater, our CEO. We want to thank everyone for spending some time with us this afternoon. Again, please do visit us on our website, lasatercapital.com. We look forward to talking with everyone soon. Thank you.